Hello and welcome everybody to another session of the My Solo 401k Financial Daily Webinar Series. We're here to discuss a great topic, which is Mega Backdoor Roth Solo 401k. Specifically, we want to focus on businesses that are taxed as sole proprietors, single member LLCs, those who report their income on Schedule C. For example, someone who receives a 1099 NEC. If you're on YouTube or LinkedIn or StreamYard or Twitter, on any of those channels, feel free to chat over questions, as we do want to take the time to go through your questions. And I see we already got a question, so we'll knock out this first question here before we jump into our prepared content. Appreciate you joining. So again, if there's other questions, please don't hesitate to chat over questions or even topics. Could be a broad topic. If you're on YouTube, please subscribe. If you're not already a subscriber, there's a lot of benefits to subscribing and then hitting that notifications bell, is because now you'll get notifications of when we go live. And then you can jump on, you can ask questions, you can hear what other people are asking. You'll also get just a stream of, the good content we're trying to bring. So we appreciate the chance to discuss these topics. So we go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. So this is our afternoon session. So we also want to highlight some of the other resources. For example, we have our community. We've got over 30,000 members on our community. It's a vibrant community. We've got forums. We have deep dive library of videos and webinars. So there's really tons of ways to learn and to share the knowledge, whether it's on these daily sessions or going to the forums or checking out our library. So we really appreciate the chance to discuss these topics. Let's see here. So here's our community link if you want to check that out. So as always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice. We would never discourage you from talking to your tax, legal, investment advisors. Please consult with your tax attorney and financial professional with those types of questions. So you can see that we have a lot of good content coming up here. Another good reason to subscribe. For example, we're going to be turning to strategy sessions soon. Specifically, the magic number of income that you would need to maximize contributions, whether your business is taxed as an S Corp or a C Corp, sole prop, partnership. Right now, we're going through our Mega Backdoor Roth Deep Dive Guide. So the next one on the docket is partnerships, and then we'll start to turn to this other content. But please subscribe and you'll get all the notifications and can join our daily sessions. So please, everyone's welcome. It's not just customers. So here's our roadmap of where we're headed. We want to talk about contribution limits, scenarios and examples, all the mechanics, like how to use our online calculator, the deadline, how to make contributions, how to report contributions, how to convert from an after-tax to a Roth, because that's really what one is doing when one is making a Mega Backdoor Roth contribution. And then we want to end it with some bonus content of the $1,500 solo 401k tax credit. Now, before we turn to this roadmap, though, as I mentioned, I want to answer the question for the individual who brought one right off the bat. So if there's other questions, though, please don't hesitate to chat those up, and we'll turn to those after we go through some of these slides. So our first question here is, how many days does it take to set up a new solo 401k so I can open my checking account? Well, we prepare the documents to create the plan within the same business day. So we're very fast, and then we're very hands-on in helping customers open up accounts at the bank or brokerage of choice. So the specific bank or brokerage processing times are going to vary, but it's going to be typically a few days. After I fund the account, how long does it take, if any, for you to process paperwork for my investment into a private placement, real estate finance deal? That's another great question, is the ability to invest in alternative investments is one of the top reasons that customers set up accounts with us. Now, we are very supportive in terms of giving educational support to our customers and helping them understand those investment rules, but we don't have control. In other words, customers don't have to come to us for approval. So we don't need to process the paperwork. So it can happen very quick. if the person's ready to go. But again, we'll be there to help educate them on those investment rules from a solo 401k perspective. I'll be transferring my solo 401k from a census to my solo 401k. So that's a classic scenario. We've had a ton of individuals move over from a census. Fortunately, a lot of them were transitioned over from Vanguard, or they could have been just had a solo 401k directly through a census. So the process is going to be what's called a restatement. So really, you just need to sign up on our online application to give us the information we need to draft the restatement documents. Now, in order to draft those documents, we're going to need the original effective date, which is typically January 1 of the year that the plan was set up, but you can find it on the adoption agreement. Because when we draft the restatement documents, the plan is going to continue. So it's not like the individual is setting up a new plan with us. That existing plan continues, but now it's going to be governed by our IRS approved plan documents. So in order to draft those restatement documents, we use that same original effective date, and then we use the restatement date, i.e. the date that the individual signed up with us. So we prepare those documents within the same business day. When someone signs up, they get a link to our secure portal where they can download the documents. They just simply download, they sign, they upload. Then from that same email, they're also going to be able to tell us where they want to have the new accounts at, because new accounts will need to be established for the restated plan. For example, those could be at Fidelity or Schwab. So then we'll guide them through the process to open up the accounts. For example, if they want Schwab, we'll prepare the paperwork that Schwab requires. And then we'll prepare the paperwork and guide the clients through the process to transfer over the cash and assets from the pre-existing accounts over to the new accounts. Now, a census, to be specific, they don't allow for in-kind transfer. So they're going to require that the money, that it transfers a cash transfer. So the investments that need to be liquidated. It's not going to be taxable, but it's moved to a cash position. Then a check is cut in the amount of the account balance provided to the account holder. And then you, as the trustee, are going to deposit the transfer check into the new account that's set up for the restated plan. For example, the new account at Fidelity or the new account at Schwab. Hopefully that makes sense. Appreciate the good question. It's a common scenario, like I mentioned. So now let's jump into our roadmap here. So again, mega backdoor Roth, solo 401k contributions, 2024 and 2025. And we're focused on businesses that are taxed as a sole proprietorship, single member LLC, Schedule C, 1099 NEC. Now, if your business doesn't fit into that category, that's okay. You can still ask questions, of course. We'll point you, for example, if you're an S Corp or a C Corp, to last week's Friday session where we did this same webinar but geared towards S Corps and C Corps. If you're a partnership, please subscribe and come back next week. We'll have that session focus on partnerships. But if you're here, also please stay and feel free to chat over questions. So we can field questions for all business types, but the slides will focus on businesses that are taxed as a sole proprietorship, an LLC taxed as a sole proprietorship. For example, a 1099 contractor who reports their income on Schedule C. So let's start broadly, and then we'll get deeper and go through specific examples. So mega backdoor Roth solo 401k. What's the benefits of a mega backdoor Roth solo 401k? Well, it's the ability to make contributions where you'll have a large contribution amount, relatively speaking, end up in a Roth account where you have that potential for tax-free growth. So as you can see, this is much higher than the Roth IRA contribution limits. For example, someone can contribute up to $69,000 or even $76,000 at their age 50 or older for 2024. And we'll talk about how there's still time to set up a plan and make contributions for 2024. And then for 2025, the limits go up, $70,000 or $77,500 if they're age 50 or older, or even $81,250 if they're age 60 to 63 for 2025. Again, with that potential for tax-free growth because the funds end up in a Roth solo 401k. So that's a great benefit. So how do you find a mega backdoor Roth solo 401k? Well, first you need to make sure you qualify. So to be qualified to set up any solo 401k, you need to be self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. Then you need to find a provider like us that offers a plan that allows for voluntary after-tax solo 401k contributions and then in-service distributions, either transferred to a Roth solo 401k or a Roth IRA. It's also helpful to work with a provider like us that has deep experience, for example, in helping clients satisfy the mega backdoor Roth solo 401k requirements. For example, the funds need to be held in separate accounts. So we help our customers establish the different required sub-accounts, pre-tax, Roth, and voluntary after-tax, as well as having an experienced solo 401k provider that helps with the ongoing compliance support. For example, when you make a mega backdoor Roth contribution, that's going to need to be reported ultimately on a 1099-R. It's a two-step process we'll learn, because you first deposit money into an after-tax account before the funds are moved to a Roth account. So that second step, the move from the after-tax to the Roth, that's reportable on a 1099-R. And we handle that 1099-R as an optional free service. In other words, no additional charge for our customers. So that's another important service you want to look for in a mega backdoor Roth solo 401k provider. So now let's start to look at how much one can contribute as a mega backdoor Roth contribution. So anytime we talk about how much I can contribute to a solo 401k, it's good to understand that there are certain basic factors that dictate how much someone can contribute. For example, the solo 401k contribution limits are based on one's self-employment income, because the whole purpose of a 401k is to save their earned income for retirement, their earned self-employment income. And you can't save more than you earn. So the first factor is going to be that self-employment income. Another factor is the age. A third factor is whether you participate in another retirement plan, like a 401k plan through a day job plan. And then the type of contribution that the individual is looking to make. Some individuals want to maximize Roth and mega backdoor Roth contributions, whereas others first want to maximize pre-tax contributions to reduce the taxable income now for the year for which the contribution is being made, and then make additional contributions if possible as Roth or voluntary after-tax. In other words, mega backdoor Roth contributions. So for businesses taxed as a sole prop, single member LLC, a 1099 independent contractor, the ability to contribute is based on self-employment income. Self-employment income is, there's a pre-calculation to determine self-employment income. Line 31 of Schedule C specifically, so your net self-employment income after your expenses, less 1/2 of the self-employment tax. Now, of course, you cannot consider W-2 wages from other sources like a day job. You can't consider investment income, such as income reported on Schedule E. Here's a good visual that just shows how you start out with line 31 of Schedule C, less 1/2 of the self-employment tax. Now, we have an online calculator that will help run that pre-calculation. And we are educating our customers every day, helping them determine how much they can contribute. Now let's turn to the contribution limits. So you've got different buckets that you can fill up with a solo 401k. That's why a solo 401k plan has the highest contribution limits for any defined contribution plan, because you can fill up different buckets. But then you also have to consider that there's an overall limit. So for 2024, the overall limit is $69,000 or an additional $7,500 for a total of $76,500 if one is age 50 or older. Because if one is age 50 or older, they can make a catch-up contribution. For 2025, the overall limit increases from $69,000 to $70,000. You still have that same catch-up contribution if you're age 50 or older, but there's now a super catch-up contribution if you're age 60 to 63. So instead of an additional $7,500, the individual can contribute $11,250 for a total of $81,250. So that's the overall limit. Then you got to recognize that there are different types of contributions, right? Again, you got different buckets. For example, the employee contribution bucket. You've also got the employer contribution bucket. And then if you have a plan like ours that allows it, one can also make Roth and or voluntary after-tax contributions. So let's start to dig into these different sub-limits. So the first one we want to look at is employee contributions. Employee contributions are also referred to as salary deferral, so it's a synonym. Here, the limit is 100% of the self-employment compensation. Remember, that's line 31 of Schedule C less 1/2 of the self-employment tax. So the individual can contribute 100% of their self-employment compensation, dollar for dollar, up to $23,000 for 2024, plus an additional $7,500 if they're age 50 or older. For 2025, that limit increases to $23,500, or $31,000 if they're age 50 or older, or $34,750 if they're age 60 to 63. This is where that super catch-up and those catch-up contribution limits come into play. Now, it's important to recognize that the employee limit applies at the employee level. So you need to reduce how much the individual can contribute to the solo 401k by contributions made to another plan, like a day job plan. Now, the exception to that general rule that you got to aggregate across all plans that the individual contributes to is the 457 governmental plan exception. So you don't have to aggregate contributions made to a 457 governmental plan with the contributions that the individual wants to make to the solo 401k. Now, of course, our plan allows for these employee contributions to be made as pre-tax contributions, which reduces the taxable income for the year for which the contribution is being made. But it also allows for these contributions to be made as Roth contributions, which means that they're going to be made on an after-tax basis, but then you have that potential for tax-free growth. The employee contribution limit is the same. So the individual could contribute all as pre-tax, all as Roth, or a combination of both. If the individual is going to contribute employee contributions as Roth contributions, they need to be deposited into a separate sub-account for each participant. Now let's turn to employer contributions. Employer contributions are also referred to as profit-sharing contributions. So that's a synonym. Here, the limit is a percentage of the self-employment compensation. Remember, you have to run that pre-calculation. If your business is taxed as a sole prop, or a single member LLC taxed as a sole prop, or a 1099 independent contractor that reports their income on Schedule C, where you take line 31 of Schedule C, in other words, your net income, reduce that amount by 1/2 of the self-employment tax, and that is considered to be self-employment compensation, which is what the number you would use to determine how much you could contribute. So the employer contribution limit is 20% of that self-employment compensation figure. Now, you've got to keep in mind the overall limit. So the sum of employee, employer, plus any voluntary after-tax contributions that are made to the plan cannot exceed the lesser of self-employment compensation or the overall limit. Remember, that's $69,000 or $76,500 if you're age 50 or older for 2024. And then it goes up for 2025 to $70,000 or $77,500 if you're age 50 or older, or $81,250 if you're age 60 to 63. So contrast the employer contribution limit with the employee contribution limit when it comes to aggregating. So for purposes of the employee limit, we learned that it applies at the employee level across all the plans that the employee makes contributions to, whereas the employer contribution limit applies at the plan level. So that means that the self-employed individual does not need to reduce how much they can contribute to the solo 401k as an employer contribution by contributions made to another plan, like a day job 401k plan. So those contributions don't have to be aggregated. Now, the exception to that general rule that you don't have to aggregate contributions made to another plan for purposes of determining how much can be contributed as an employer contribution to the solo 401k, an exception to that rule is the 403b exception. So all contributions that are made to the 403b, whether it's employee, employer, together with any contributions that the individual wants to make to the solo 401k, whether it's employee, employer, or after tax, the sum of those amounts cannot exceed the overall limit. Now, Secure Act 2.0 now allows for these employer contributions to be made as Roth contributions. Historically, they were always made as pre-tax contributions, as tax-deductible contributions. But now Secure Act 2.0 allows for these employer contributions to be made as Roth contributions, for our customers, for our client base, based on experience and client feedback, this is really not a big deal. In other words, not a lot of customers started to make employer contributions as Roth contributions. And that's because our plan already allowed for mega backdoor Roth contributions. So based on experience and client feedback for customers that were focused on maximizing the amount that they can contribute as a Roth contribution, they preferred to make those contributions as voluntary after-tax contributions, as opposed to making employer contributions as Roth contributions. So why is that? Well, number one, they didn't need as much money. You don't need as much money to be able to maximize the voluntary after-tax contributions to the solo 401k. Because unlike employer contributions, where the contribution limit is a percentage of the self-employment compensation, the voluntary after-tax contribution limit, as we'll learn here on the subsequent slides, is 100% of the self-employment compensation, dollar for dollar. So in contrast with an employer contribution, where one would need 5 times the amount of the contribution that they want to make as self-employment compensation to justify that employer contribution, because the limit is 20% of self-employment compensation, one can contribute 100% dollar for dollar of their self-employment compensation as a voluntary after-tax contribution. So it's easier to hit your contribution limits. From a deadline perspective, voluntary after-tax contributions and employer contributions, the deadline is the same. So that's a wash. Lastly, in terms of why someone would choose to or prefer to make voluntary after-tax contributions as opposed to making employer contributions as Roth contributions, is that there's more flexibility with respect to voluntary after-tax funds. So specifically, one can transfer voluntary after-tax funds out of the solo 401k to a Roth IRA without having to meet a triggering event. Whereas one would need to meet a triggering event before they transferred those employer contributions made as Roth contributions out of the solo 401k, even if they're going from a Roth solo 401k to a Roth IRA. For example, a typical triggering event is being at least age 59 and a half or older. So there's more flexibility with those voluntary after-tax funds. That'd be another reason that our clients would prefer to just make the voluntary after-tax contributions as opposed to making employer contributions as Roth contributions. But with that stated, what are some of the FAQs for those who ultimately do choose to make employer contributions as Roth contributions? Well, number one, do I need to deposit those employer contributions made as Roth contributions into a separate account? The answer is no. Both employee and employer contributions made as Roth contributions may be deposited into the same bank or brokerage account. What is the contribution limit for employer solo 401k contributions made as Roth solo 401k contributions? Well, the contribution limit is the same as we discussed, whether the individual is choosing to make those employer contributions as pre-tax contributions or as Roth contributions. It's 20% of the self-employment compensation. Lastly, how do I report employer contributions made as Roth contributions on my personal or business tax return? Well, this was an open question because, as we discussed, historically, employer contributions were always made as pre-tax contributions. But now that the individual could choose to make those as Roth contributions, there was a question, because if you're going to make a Roth contribution, it ultimately needs to be made on an after-tax basis. So this was an open question for almost a year after the Secure Act 2.0 was enacted and allowed for employer contributions to be made as Roth contributions. So almost a year later, with IRS Notice 2024-2, the IRS clarified how to report employer contributions made as Roth contributions. And per that guidance, Roth employer contributions are reported as tax deductible on the employer's return, i.e. the 1040 for a business tax as a sole proprietor, for the year for which the contributions are made, but then reported as taxable to the employee for the year for which the contributions are deposited. Now, sometimes that's the same year, but oftentimes for a business that's a self-employed business where the person is making contributions to a solo 401k, contributions will not be made in the same year for which those contributions are made. In other words, the contribution deadline is the business tax return deadline, including any timely filed extension. So for example, we have many clients who here in 2025 are making 2024 contributions. So in that case, if that employer contribution is made as a Roth contribution during 2025, but for 2024, it'll be tax deductible on the employer's return, in this case, the 1040 for 2024. So it'll reduce the taxes on the 2024 return, but then it'll be taxable to the employee for the year of the deposit. In other words, 2025. So ultimately, they'll be effectively lowering their taxes on their 2024 return, but then raising them on their 2025 return. Okay, so now let's turn to the voluntary after-tax solo 401k contribution limit. So the limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit. In other words, it's the lesser of self-employment compensation and the overall limit. Recall that the overall limit is $69,000 for 2024, $70,000 for 2025. Now, you do have to keep in mind that overall limit. In other words, the sum of all the contributions that are made to the solo 401k, whether employee, employer, or voluntary after tax, cannot exceed the overall limit. So in other words, the individual has to reduce how much they can contribute as a voluntary after tax contribution by any employer or employee contributions made to the solo 401k. Now, there is a special rule that one ignores, so you don't have to reduce by any catch-up contributions made to the solo 401k. So this is another way of saying that if one is making catch-up contributions, they can't make those catch-up contributions as voluntary after-tax contributions. They're either going to be made as pre-tax employee or Roth employee. Now, it's noteworthy that like the employee contributions that are made as Roth contributions, voluntary after-tax contributions need to be deposited into a separate sub-account for each participant. This is how one ends up with 3 different accounts: pre-tax, Roth, and after-tax. It's also noteworthy that more like employer contributions, the ability to make voluntary after-tax contributions is not reduced by contributions made to another retirement plan sponsored by an unrelated employer, like a day job 401k plan. So unlike the employee limit, where you have to aggregate all contributions made by the individual to all the different plans that they participate in, one doesn't have to reduce how much they can contribute as a voluntary after-tax contributions by contributions made to a day job 401k plan. Now, the one exception to that rule that you don't have to aggregate is the 403B exception. So remember, any contributions made to a 403B, whether employee or employer, together with any contributions that the individual wants to make to the solo 401k, the sum of those amounts cannot exceed the overall limit. So now we want to apply these rules to different contribution scenarios to illustrate how it works. So we're going to start out with some base scenario assumptions and then see how much we can contribute in each scenario. And as we go through these scenarios, we'll change the factors to illustrate different points. So our basic scenario is a self-employed business taxes the sole proprietorship, single member LLC, or it could be a 1099 independent contractor who reports their income on Schedule C. Here we're presuming that it's one person who's under 50 years of age, does not make contributions to another plan like a day job plan. Their goal is to, their goal is to maximize pre-tax contributions and then make any additional contributions as Roth and or voluntary after-tax contributions. We're going to assume that the product of their pre-calculation is $100,000. In other words, line 31 of Schedule C less 1/2 of self-employment tax is equal to $100,000. Finally, we're going to assume that all employer contributions are made as pre-tax contributions. Okay, so how much can this individual contribute? Well, they can make a $23,000. Now, this is presuming that the person set up the plan either by December 31st. We'll talk about the deadlines in a moment, but just to put it out there, they either signed up with us by the end of December 31st, or because their business is taxed as a sole proprietorship, they sign up with us here in 2025 in time to make contributions, all contributions by April 15th, because then they'll be able to make all contributions for 2024 by April 15th. If it's after April 15th, they could still sign up, but they'd only be able to make employer or voluntary after-tax contributions for 2024. So that's assuming they didn't have another plan somewhere else, like a basic plan at a discount brokerage that they're restating. So in this basic scenario, the individual is going to be able to contribute $23,000 for 2024 as a pre-tax employee, $20,000 or 20% as a pre-tax employer. So they got $43,000 in their pre-tax account. And then they can do the difference up to the overall limit of $69,000. In other words, $26,000 as a voluntary after-tax contribution. And then they'll move that voluntary after-tax funds over to their Roth account. So at the end of the day, they got $43,000 in their pre-tax account, $26,000 in their Roth account. Now for 2025, they're going to be able to contribute in that scenario $23,500 as a pre-tax employee, the same $20,000 pre-tax employer, and then they can do the difference up to $70,000 as a voluntary after-tax, and then move the funds over from the after-tax to the Roth. So for 2025, they'll end up with $43,500 in their pre-tax solo 401k account, $26,500 in their Roth solo 401k account. So now let's change the basic scenario. Instead of $100,000 of self-employment compensation, let's assume that the product of line 31 of Schedule C less 1/2 of the self-employment tax is $50,000. So in that case, their employee amount is going to stay the same, but their employer contribution amount is going to change because now it's 20% of $50,000 or $10,000. Likewise, their voluntary after-tax amount will be less. This is a good illustration of how the total amount of contributions to the plan cannot exceed the lesser of self-employment compensation or the overall limit. Here, self-employment compensation is less than the overall limit. So for 2024, they're going to be able to do the difference up to $50,000, in other words, $17,000 as a voluntary after-tax, and then move those funds over to the Roth solo 401k. For 2025, they're going to be able to do $16,500 as a voluntary after-tax and move those funds over to the Roth solo 401k. So now let's go back to the baseline scenario, back to $100,000 of self-employment compensation. But now let's assume this individual is participating in a day job 401k plan, and they maximize the contributions, those employee contributions to the day job plan. So how does that impact how much they can contribute to the solo 401k? Well, that means they're not going to be able to make any employee contributions to the solo 401k. So this illustrates how that employee limit applies at the employee level. And so since the individual maxed out the contributions to the day job plan, they're not going to be able to make any employee contributions to the solo 401k. The employer limit's going to stay the same, right? It's still 20% of $100,000 or $20,000. And now the voluntary after-tax limit, though, will go up. So this is a good illustration of how the voluntary after-tax solo 401k contribution limit is not reduced by contributions made to a day job plan. So for 2024, they're going to be able to contribute the difference up to $69,000 or $49,000 as a voluntary after-tax contribution. For 2025, they're going to be able to contribute the difference up to $70,000 or $50,000 as a voluntary after-tax contribution. And then they can move those voluntary after-tax funds over to their Roth solo 401k. So for 2024, they'll end up with $20,000 in their pre-tax account, $49,000 in their Roth solo 401k account. For 2025, they'll have $20,000 in their pre-tax solo 401k account, $50,000 in their Roth solo 401k account. So now let's go back to the base. And here we're going to assume that they're not making contributions to another plan, $100,000 of self-employment compensation, but they're only focused on Roth and voluntary after-tax contributions. So they'll make the same employee contribution amount, but instead of contributing to the pre-tax solo 401k account, they're going to put this employee contribution into the Roth account. Here, they're not interested in making employer pre-tax contributions, so they'll skip making employer contributions, and they'll just make the difference as a voluntary after-tax contribution, and then move those funds from the voluntary after-tax solo 401k account over to the Roth solo 401k account. So for 2024, they'll end up with $69,000 in their Roth solo 401k, $70,000 for 2025 in their Roth solo 401k. Okay, so now let's go back to the base, back to presuming that they first want to maximize pre-tax and then make any additional contributions as Roth or voluntary after-tax contributions. But now let's assume that there are two participants. For example, it could be two spouses that are both working in the same business, both participating in the same solo 401k plan. And let's assume that each spouse's profile is the same, right? Each spouse is under 50, each spouse has $100,000 of self-employment compensation, etc. So here the limits don't change. So what this scenario illustrates is that the ability for each participant to make contributions is based on their situation, right? Their age, their income, their contribution goals, etc. So now let's go back to the base, back to one participant, but now let's presume that the individual is 50 or older. Let's assume they're 55, for example. So how much can they contribute? Well, it's going to be the same amounts, with the one exception that now they're going to be able to make the catch-up contribution. So for 2024, they're going to be able to do an additional $7,500 of a catch-up contribution to the pre-tax account. For 2025, they're going to be able to do that same $7,500. And if instead of 55, they were age 60 to 63, they could do $11,250 instead of $7,500. This is also a good illustration that the voluntary after-tax limit doesn't change. Remember, we said that you can ignore the catch-up contribution when determining how much you can contribute to the voluntary after-tax account. So you'll end up being able to contribute that same amount to the voluntary after-tax. So that's how you end up being able to contribute. For example, in sum, if you add up all these different contribution buckets, right, 76,500 for 2024, 77,500 for 2025. So now let's go back to the base, back to being under 50 years of age. And let's assume now that they're maxing out contributions to their day job plan. And finally, let's assume that they're not interested in making pre-tax contributions, only Roth or voluntary after-tax contributions. So they're not going to be able to make any employee contributions to the solo 401k because they already maxed out the contributions to their day job plan. They're not interested in making pre-tax contributions. They're only interested in making Roth and mega backdoor Roth contributions. So they'll skip making employer contributions, and they'll just simply make the entire contribution as a voluntary after-tax contribution. $69,000 for 2024, $70,000 for 2025. They'll then move the funds from the after-tax account to the Roth solo 401k account. So at the end of the day, they got $69,000 in their Roth solo 401k for 2024, $70,000 in their Roth solo 401k for 2025. So now let's go back to the base. Now let's assume they're 50 or older. Again, they max out contributions to their day job plan. And again, they're not interested in making pre-tax contributions, only Roth or mega backdoor Roth contributions. So again, they're not able to make employee. They're not interested in making employer pre-tax contributions. So they end up contributing that full amount as a voluntary after-tax contribution. So what this scenario is illustrating is, again, the catch-up contribution is not made as an after-tax contribution. It's made as an employee contribution. And here, the individual already made their catch-up contribution to their day job plan. So now let's go back to the base. Now we're back to two participants. Let's say it's the two spouses. They each maximize contributions to their day job plan. They're each only interested in Roth and mega backdoor Roth contributions. They each have $100,000 of self-employment compensation. So again, this shows that the limits don't change, right? Each person's going to be able to contribute $69,000 for 2024, $70,000 for 2025 as voluntary after-tax contributions, and then move those funds over to the respective Roth solo 401k accounts. So this illustrates how the ability for each participant to contribute is based on their situation, right? Their income, their age, etc. All right, so that takes us through the scenarios. So now we want to turn to some of the mechanics. So we have a calculator on our website. You can easily find it if you go to mysolo401k.net. There's a menu under Learn. Just click on, there's a drop-down menu. Just click on Online Tools. That'll take you right to the calculator. So it's a great resource, right? You can choose sole proprietorship. You can choose the year. You can enter your net income from line 31, and it'll calculate 1/2 of self-employment tax for you. Now, it's not going to accommodate a scenario where you're making contributions to a day job plan. So you got to modify in that scenario. You'd also need to modify if you're trying to make after-tax contributions. But you can view the report to see the detail. You can print to keep a copy. So let's keep going with the mechanics. How do I make contributions? Well, from a solo 401k perspective, it's totally acceptable to make those contributions by check, by electronic transfer. Now, if you're gonna make it by check, write annual contribution in the memo section of the check. If you're gonna make it by electronic transfer, check with the financial institution that holds the accounts. Now, we are neutral as far as where customers open up the accounts, but we're very hands-on in helping customers open up the accounts at the bank or brokerage of choice. The top brokerage option is Fidelity. Now, one of the reasons I would say is that Fidelity has the most options in terms of being able to make contributions. And Fidelity will allow for electronic deposits from external accounts where the name doesn't match the name on the brokerage account. Because remember, that brokerage account is going to be set up under the name of the plan, and the individual might be making contributions from, say, their personal account or their business account. But Fidelity is the exception in comparison to the other brokerages where customers are opening up accounts. For example, like Schwab, where those other brokerage firms generally won't allow for an electronic deposit from an external account where the name on the external account isn't in the name of the plan, right? Where it doesn't match the name on the brokerage account at the firm. Each participant will deposit his or her contributions into separate sub-accounts. Moreover, there'll be separate sub-accounts for different types of funds, right? Like pre-tax, Roth, and after-tax. This is how you end up with 6 different accounts. What is the deadline to make contributions? Well, the rules are different for self-employed individuals, right? In comparison to like a big corporate 401k plan where the employees have to make the contributions by the end of the year. For a solo 401k, for self-employed individuals, as long as the plan is set up by the end of the year, you'll preserve the ability to make all types of contributions, whether employee, employer, or voluntary after tax, by the business tax return deadline, including extension. So for a sole proprietorship, April 15th or October 15th, if you file a timely extension for your 1040. And this is clear based on IRS Publication 560. IRS Publication 560 is the landmark guidance for self-employed retirement plans like solo 401ks. Now, Secure Act 2.0 introduces some additional deadlines. So we'll talk about that. So when is the deadline to make contributions? So the deadline that'll give you the most options with the most time is to sign up by the end of the year. So for those who signed up by December 31st, they would have preserved the ability to make all types of contributions by their business tax return deadline, including extension. But even if those who didn't either have a plan somewhere else or sign up with us by the end of the year, so you're setting up a new plan here in 2025, there are still options to be able to make 2024 contributions. So for a business tax as a sole proprietorship or an LLC tax as a sole proprietorship, as long as the plan is set up and accounts are made in time, opened, I should say, in time to make contributions by April 15th, that individual can still make all contributions for 2024, whether employee, employer, or voluntary after tax by April 15th. Otherwise, if they set up the plan after April 15th, 2025, they could still set up a plan and make contributions by October 15th, but only employer and voluntary after-tax contributions. In other words, they'll lose the ability to make employee contributions for 2024. So this is a great slide as it just illustrates how that contribution deadline is really dictated and determined by how the business is taxed, whether it's a sole prop or an S Corp or a C Corp. And here's the deadlines for 2025. So for folks that are setting up a plan here in 2025, they're preserving the ability to make all types of contributions, whether employee, employer, or voluntary after tax for 2025 by the 2025 tax return deadline next year in 2026. All right, so let's take a look at this slide here. I want to clarify that. 1 second, please. It's going to be easier to read here. Okay, great. So how do I report contributions? Well, that's a great question. And it depends on the type of contribution that we're referring to. So if it's an employee pre-tax contribution, it needs to reduce the taxable income. And the way that that does that is by reducing it on line 16 of Schedule 1 of the 1040. for a business that's taxed as a sole prop, like an LLC taxed as a sole prop, or an independent contractor who reports their income on Schedule C. If it's a Roth or voluntary after-tax contribution, a voluntary after-tax contribution is a type of employee contribution, there's no place to report it for a business that's taxed as a sole proprietorship. Now, if it's an employer contribution, remember, that was that open question for those Roth employer contributions, but it was answered by IRS Notice 2024-2. So whether it's a pre-tax or a Roth employer contribution, it's reported as tax deductible for the year for which the contribution is made on line 16 of Schedule 1 of the 1040. And then if it's a Roth employer contribution, it's reported as taxable to the employee for the year in which it's deposited, right? So if it's that 2024 employer Roth contribution that's deposited here in 2025 by the business tax return deadline, including extension, that'll reduce the taxable income on the 2024 1040, line 16 of Schedule 1. But it'll be taxable to the employee on the 2025 tax returns. They'll have to add that income on their 1040 via a 1099-R that will report that as a taxable transaction. So we've talked about how the mega backdoor Roth contribution is a two-step process because you first have to deposit the funds into an after-tax account before they're moved over to a Roth account. So mechanically, how do I convert after-tax to Roth? Well, from a solo 401k perspective, it's totally acceptable to transfer the funds by check or by electronic transfer. The specific procedure for electronic transfers are going to depend where the account is at. Remember, we help customers open up accounts at hundreds of different banks, many different brokerages. It's possible even to transfer between bank and brokerage. So if you have an after-tax, say, brokerage account, and you want to transfer it to a Roth bank account, that's acceptable from a solo 401k. In addition, the funds can transfer not only from an after-tax solo 401k account to a Roth solo 401k, but can also even transfer out of the plan to a Roth IRA. Remember, we talked about how in deciding whether to contribute between employer Roth versus voluntary after-tax, there's more flexibility with voluntary after-tax funds because those funds can be transferred out of the solo 401k to a Roth IRA without the need to meet a triggering event. So the most popular brokerage option amongst our client base is Fidelity. So the procedure would be to open up Fidelity brokerage accounts or brokerage account for voluntary after-tax funds, and we're very hands-on in helping our customers do that, make the voluntary after-tax contribution, and then convert those funds either to a Roth solo 401k, so an in-plan conversion, or out of the plan to a Roth IRA, such as a Roth IRA at Fidelity. And then finally, customers need to let us know about that transfer from the after-tax to the Roth. Because remember, the voluntary after-tax contribution itself, that first step in the process, that's not reportable. There's no place to report voluntary after-tax contributions for a business taxed as a sole proprietorship. But that second step, the move from the voluntary after-tax account to the Roth, that is reportable on a 1099-R issued by the plan. We provide that service as an optional free service. In other words, no additional charge. We have forms on our website that customers use to provide us the information. If you go to mysolo401k.net/forms, it'll take you right to the page and you can choose the applicable online form. It's going to be a very similar process at Schwab, right? An account is opened at Schwab for voluntary after-tax solo 401k funds. The funds are either converted to a Roth solo 401k, so another brokerage account at Schwab in the name of the plan for Roth solo 401k funds, or out of the plan to a Roth IRA. Then customers let us know about the transfer to give us the information we need to prepare the 1099-R. Common question is going to be, should I transfer to a Roth IRA or a Roth solo 401k? Well, there used to be more differences between a Roth IRA and a Roth solo 401k. They've become more alike. Specifically, now, just like Roth IRAs, Roth solo 401ks are not subject to required minimum distributions. So in that way, they're more alike. There are still some differences, though. For example, customers will choose to keep the funds in the Roth solo 401k because they want to preserve the ability to take a loan, one cannot take a loan from any type of IRA, including a Roth IRA. Whereas with our plan, it does allow for 401k loans where the individual can withdraw money from their solo 401k and use the funds for any purpose whatsoever, as long as it's properly documented as a loan and paid back according to the loan terms. It's not going to be subject to taxes or penalties. In addition, the ability to invest in alternative investments. So with our plan, it allows for not only typical brokerage type investments like stocks, bonds, mutual funds, but also true alternative investments like real estate, crypto, etc. And so for those folks that want to invest in alternative investments, or at least keep that option open, they'll keep the money in the Roth solo 401k. Because remember, if you transfer the voluntary after-tax funds out of the plan to a Roth IRA, they can't come back because those Roth IRA rules don't allow for Roth IRA funds to be transferred to a Roth solo 401k. And so if you're investing in, say, real estate, some customers want to use their Roth solo 401k funds together with debt, a mortgage, and it's possible to do that. Now, it needs to be a specific type of financing, what they call non-recourse financing, but essentially they're making a leveraged investment, right? They're combining their Roth solo 401k funds with debt to invest in real estate. So the general rule is that when one makes a leveraged investment inside their retirement account, so a debt financed investment, a tax will apply to their retirement account. The name of that tax is referred to as unrelated debt finance income tax, or UDFI, but there's an exception for debt financed real estate investments inside a solo 401k. There isn't that same exception for debt financed investments inside a Roth IRA. So that's a big advantage for those that want to invest in those types of investments. And that would be another reason that they would choose to transfer those voluntary after-tax solo 401k funds to a Roth solo 401k. Now, reasons why someone might want to transfer those voluntary after-tax funds out of the plan to a Roth IRA could be just a practical reason that they might have a Roth IRA that they're pleased with the performance and they just want to continue to deposit funds into that Roth IRA to grow that Roth IRA account balance. The rules when it comes to taking funds out of the Roth IRA are more permissive as opposed to a Roth solo 401k. So with the Roth IRA, one is allowed to first withdraw their contributions, their basis. Then they're allowed to withdraw their conversion, so money that was transferred over, before they have to start taking out the gains. Because if they take out the money early, it's going to be subject to taxes and possibly penalties. Whereas with a Roth solo 401k, you can't take out the funds in layers like that. You need to, if one makes an early withdrawal from the Roth solo 401k, they're going to have to take a proportionate amount of the contributions plus the gains. And so if it's not a qualified Roth solo 401k distribution, because they haven't had the account for at least 5 years and they're not at least age 59 and a half, they'll end up needing to pay taxes on those gains. So that could be another reason that might drive someone to want to transfer those voluntary after-tax solo 401k funds to a Roth IRA. Now, there is no deadline to convert from an after-tax to a Roth, right? There's a deadline to make the contribution, but no deadline for that second step. And the reporting, the 1099-R for that second step, would be for the year of the conversion. So that's why we end up having folks, for example, who are making their 2024 after-tax contributions now in 2025, transferring in 2025. So even though the source of those funds was a 2024 after-tax contribution, because the funds were not transferred from the after-tax to the Roth until 2025, it's not going to be issued on a 2024 1099-R. It'll be issued on a 2025 1099-R by February of 2026. And then they'll need to report that after-tax to Roth transfer on their 1040. So it's going to be non-taxable with respect to the contribution amount. If there does happen to be some small gains because the funds, for example, sat in that after-tax account for a short period of time or maybe longer, the gains portion will be taxable. But then, of course, now the entire amount will have that potential for tax-free growth because now it'll all be post-tax dollars in that Roth account. This is a great visual. It just shows how you've got those different sub-accounts, right? Pre-tax, Roth, and after-tax. If it's 2 participants, you end up with 6 accounts, pre-tax, Roth, and after-tax for each. or if the individual is transferring from an after-tax to a Roth IRA out of the plan, they might just have two or even one account for the solo 401k, right? If they only have after-tax money in the solo 401k, they might just have that one after-tax account, and then the funds are transferred out of the after-tax solo 401k to a Roth IRA. All right, so that we want to get to the bonus content in a moment here, but let's knock out some of these questions. Appreciate your patience and bringing the questions. Can I file 2024 tax and claim $23,000 contribution now, but won't actually make the contribution till April 1st? Yes. So if the plan was set up in time, if the business is taxed as a sole proprietorship, it's even possible to set up a new plan here now, as long as the plan is set up in time to make the contribution by April 15th. Of course, if the plan was set up before December 31st, the individual would have until April 15th or October 15th to file a timely extension to make all types of contributions for 2024. So the deadline is not when you file your tax return. It's the deadline is the tax return deadline. So even if somebody files their tax return now, they technically would have until the tax return deadline to deposit the contributions. Obviously, you want to be careful to make sure you do that. Good question. Once I've contributed to my pre-tax solo 401k, when am I supposed to transfer that over to my Roth solo 401k? Do I do it immediately after funding the pre-tax account or wait until end of year? So if one is making a pre-tax contribution, that's going to reduce their taxable income for the year for which the contribution is made. And then if they then transfer the money to a Roth solo 401k, that'll be taxable for the year in which the money is transferred. So if they do that in the same year, it's going to be a wash. So they'll end up washing out that tax deduction benefit of making a pre-tax contribution. But if they want that pre-tax to Roth transfer to be taxable, for example, in 2025, the transfer would need to occur by December 31st of 2025. And then we have an online form the customers use to let us know about that transfer, so we can capture the information that's needed to prepare the 1099-R to report it as a taxable transfer. All right, wonderful. So again, if you're on YouTube, please like, please subscribe, please share with anyone who think, and any of the channels who you think might be interested in this content. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. We're back again at 1 p.m. Pacific, 4 p.m. Eastern. So if you subscribe, hit the notification bell, then you'll get the notification. You can jump on and ask questions. So all are welcome. It's totally free to join. So we want to go through some bonus content here as far as qualifying for the $1,500 tax credit. So the Secure Act did authorize a number of tax credits to encourage businesses to set up 401k plans. One of those tax credits is the startup cost credit, which is not available to a self-employed individual that sets up a solo 401k. Because in order to be eligible for the startup cost credit, you would need to have non-owner employees participating in the plan. But another separate tax credit that has separate eligibility requirements is the automatic participation credit, which is eligible for an owner-only business as long as they set up a solo 401k plan that, like ours, that includes that automatic contribution feature. So that tax credit is going to provide $500 per year for 3 consecutive years, so a total of $1,500. It's available to both new solo 401k plans as well as individuals that upgrade their existing plan to our plan. For example, they might have a basic plan at a discount brokerage that they upgrade to our plan. It's not based on the actual cost. So unlike the startup cost credit, even though the amount of the credit is more than our fees, the individual is going to be able to claim the full $1,500 in tax credit. So it's not limited to the costs. So if the individual signs up here for a new plan in 2025, they'll be able to start claiming the credit when they file their 2025 tax return. And then again for 2 more years for a total of $1,500. Or if they upgrade an existing plan here in 2025, they'll be able to start claiming the credit when they file their 2025 tax return. And then again for 2 more years, as long as they maintain the plan with the automatic participation feature. The cost impact is tremendous, right? We charge $650, which includes our $525 initial fee, plus our $125 annual fee for a total of $650. So your net cost in the first year is $150. Going forward, we charge $125. So for example, if you sign up here in February of 2025, the annual fee would be due in February of 2026. So in the second year and the third year, the value of the credit is more than our costs. So ultimately, these $1,500 in tax credits is going to more than cover our fees for the first 7 years. So the impact of the cost is tremendous. It's a tax credit, not a tax deduction. With a tax deduction, the individual is able to reduce the income upon which their tax is calculated. Whereas with a tax credit, you first determine your tax liability and then you reduce that liability dollar for dollar. So in that way, a tax credit is much more advantageous than a tax deduction. Again, to be eligible, you need to set up a plan like ours that includes the automatic contribution feature. That automatic contribution feature sets a default 3% contribution percentage, but you as the solo 401k participant have the right to opt out of that default percentage amount, which would give the individual the option to make contributions in whichever amount or schedule they prefer. In other words, you're not even required to make annual contributions to qualify for the credit. So opting out doesn't mean that the individual is not eligible to claim the credit. Again, if you have an existing plan, it can be upgraded to our plan to then be eligible to claim the credit. You claim the credit by filing Form 8881. It's a short 2-page form. We have a deep dive webinar that we hosted with an IRS enrolled agent that goes through step-by-step how to claim the credit. We provide that to all of our clients, of course. So just to give a couple examples, Lindsay's self-employed. She has a solo 401k plan. She upgrades to our plan here in 2025. So now she'd be able to start claiming the credit of $500 when she files her 2025 tax return. Then again, for 2 more years for a total of $1,500, as long as she maintains the plan with the automatic contribution feature. Then Brad is a solo attorney with no employees working for him. Therefore, he's eligible to set up a solo 401k. So if he signs up here in 2025, he's going to be able to claim that $500 tax credit when he files his 2025 tax return. Then again, for 2 more years for a total of $1,500, as long as he maintains the plan with us, with the automatic contribution feature. All right, wonderful. Well, that takes us to the end of this presentation for today. We appreciate all the great participation. Again, please like, please subscribe, please share. Please continue to engage. Come into our webinars, our forums. Please don't hesitate to reach out. Thank you so much, everyone. All the best.